Time to check out the latest earnings trends with Chief Stock Strategist Dirk Van Dyke. Well, even though earnings season technically got started last week, this week it really gets kicked into a little higher gear here. So we thought that it was nice of Dirk Van Dyke to offer to come on in and talk about exactly what trends we might be seeing in this third quarter earnings season. I'm going to start with, do you expect earnings to surprise to the upside?
Yeah, they always do. I suspect that they will surprise less to the upside than they have in the past. I mean, normally the rule of thumb is in the S&P 500 you get about 3 times as many positive surprises as disappointments. Right now, with the 37 that have already reported through last Thursday's close, it's running 2.3 to 1. And the median surprise is 2.87%. That's also a shade lower than we've seen in the past. Usually 3% is about normal. So it's acting a little bit softer than normal, but I fully expect that the earnings will be higher than the current expectations of about 10% in total. And if you back out the financials, which are always a bit on the flaky side, we're looking at about 2.3%, or 12.3%.
Yeah, let's key
growth.
in on those financials a little bit. What are you expecting from that group this season?
Yeah, well, we've already gotten a couple of good indicators with J.P. Morgan and this morning Citi, and I haven't had time to pore over the Citi numbers. But the theme seems to be the actual earnings hit the estimate, but the quality, once you scratch underneath the surface, is pretty weak. I mean, it's reserve releases, not a lot of revenue growth there. It's an area that I would be pretty cautious about, particularly the big money center banks, really on both sides of the Atlantic, because we could have really big problems coming out of Europe, and the cities and the B of A's of the world are much more exposed. If you really need a bank, I'd look for Canadian banks, which look pretty good, or some of the little small regional.
They seem to be making a comeback.
They seem to be making a comeback, but they're still not seeing a lot of revenue growth. I mean, you've got a very low interest rates, low cost of funding, but now the long-term interests are coming down. That's not going to do a great thing for net interest margins, and there's a lot of pressure on the fees.
Let me ask you this. What percentage, or is it too early to tell, or can you even put a number on it, but what percentage of decline in the S&P 500 estimates for Q3 do you think are going to be due to the financials?
Well, there's a gap of about, if you look at the expected growth year over year in total, it's 10.1%. If you look at it Xing out the financials, it's about 2.4%. It's combining the 37 that have already reported with the 463 yet to report. And so, probably about a 2% gap, maybe a little bit more. But the financials are going to be, I think, the area that's sort of ripest for disappointment.
What's the big one standout performer for you, sector-wise?
Well, you're going to, for the third quarter, you're going to get great numbers out of energy and materials, and because you have to remember we had a collapse in commodity prices, but it happened right at the end of the quarter. So most of the quarter you had very high year-over-year energy prices and prices for copper and stuff like that. So those are going to, without a doubt, be the highest year-over-year growth coming out of the industrials will look pretty good. Some of those real sort of cyclical sectors are going to look pretty good, but I think the guidance is going to be a lot more important than the reported earnings in those sectors.
Talk to me about expanding net margins. It's been a big key to earnings growth lately.
Yeah, I mean, and it has been, although this quarter you probably is going to be less of a story, basically because the revenue growth is surprisingly going to be pretty strong at close to 8-9%. And there's another area where the financials, if you exclude the financials, revenue growth is going to be much better. Financials are really lagging on the revenue side, but they've been able to make it up in margins. But then again, revenues in particular are sort of hard to gauge with the financials. It sort of has a different meaning than for most of the other companies.
So when the dust settles on 3Q, what's it going to look like?
I think that it's going to actually look remarkably like the second quarter. Actually, the expectations now for the third quarter are almost identical to what we had in the second quarter. And in the second quarter, you ended up with the non-financials growing at 19-20%, and the financials, you include everybody, that brought it down to about 12%. But yet, Bank of America posting massive charges, which technically are recurring earnings for a bank.
So full year tells the bigger story?
Full year, we're continuing to have solid growth. You're going to be up about 14% in 2011 over 2010. 2010 was a blowout year, particularly with the financials. 47% growth, 28% ex financials. But even looking ahead to next year, the S&P 500 is going to earn over $1 trillion next year. And that's going to put the EPS for the S&P 500 over $100 a share, about $107 a share. That's up, better than 10% in total. Again, ex at the financial, just shy of 10%.
Yep.
That's pretty good at these valuations.
All right. I got to leave it there for time. You can read more about the latest earnings trends as outlined by Mr. Van Dyke in his text piece that accompanies this video in the earnings trends section of the website. And he puts a brand new text piece up there weekly. So keep your eye for his latest thinking as it may change or stay the same on the earnings trends for third quarter. With Dirk, I'm Terry Ruffalo.